Hey everyone, hope you're all doing well. With Bitcoin hitting new highs, some of the old free money trades are starting to emerge again. The main one I've been watching is the spread between the probabilities of Bitcoin hitting different prices on Polymarket versus the probabilities implied by various listed options on the Bitcoin ETFs. Basically, to the surprise of no one, Polymarket tends to overestimate the probabilities of Bitcoin going to high prices relative to the listed options on iBit and other places. So I want to go over some specific things that you could do here depending on your view about where Bitcoin is going to go and how much risk you want to take. To start out, iBit is an ETF type thing that holds Bitcoin, and generally I think it has the most liquid options of any of the Bitcoin ETFs. Spreads are pretty tight and a fair amount of options trade in this every day. For reference, roughly 1,750 shares of iBit are equal to a Bitcoin, which means if Bitcoin hits 125K, iBit will be around 7140. And if you're looking at the price of iBit for a given price of Bitcoin, you can just divide the price of Bitcoin by 1,750 to get the equivalent iBit price. Polymarket also has binary options where you can bet on the price Bitcoin is going to hit this month. Importantly, these Polymarket bets are barrier options, which I guess is the term Wall Street types use to describe a bet where if it touches that price, the bet pays out. These iBit options are vanillas, which means it's all based on where the price is at expiration, which is an important distinction when it comes to arbing these, which we'll get into a little bit later. So because the yes shares on Polymarket for Bitcoin hitting 125K are too expensive, if there's a way to replicate the payoff of those shares using iBit options, you can sell the yes shares on Polymarket or buy the no shares in other terms, and buy the iBit options for a risk-free arb. There are a few different structures I'll go over in a minute depending on whether or not you have a directional prediction on the Bitcoin price. But first I want to think about how to structure an arbitrage in the cleanest way. So right now you can buy a 70-71 iBit call spread for 31 cents, give or take a few cents. If Bitcoin hits 125K, which is a price of around 71.40 for iBit, you could then delta hedge this spread to lock in the intrinsic value of $1, because effectively at that point your spread has hit its max intrinsic profit. And this is the slightly hard part of the trade, which we'll get into in a minute and requires some monitoring on your end. But high level, you can buy this bet for 31 cents that if Bitcoin hits 125K, will settle to $1. You can then buy this bet on Polymarket that Bitcoin will not hit 125K for 45 cents that also settles at $1. Combine these two things and you can basically buy $1 for 76 cents plus some transaction costs and potential slippage from the hedging if it gets to that point. And now that Bitcoin has gotten a little bit lower, the spread is a little bit tighter, but this arb is still there, and invariably I'm sure Bitcoin will go back up to the highs again, and so you can be ready to put on this spread for a really plus EV trade if you want to. Of course, not financial advice, this is all just gambling, etc., but this is just one of the many stupid things that is happening right now. To go back, the basic observation here is that the Polymarket probabilities of Bitcoin hitting certain prices are too high, and from that you can structure a whole bunch of different bets. So right now, I'm just short the yes share or long the no shares. I don't have a position in iBit. I'm just taking the directional risk. The hard thing with doing this as an arb is you have this Polymarket bet that pays out if Bitcoin hits 125K, and you have this call spread that settles at expiration. But before expiration, Bitcoin could hit 125K and the market could call BS on that, meaning the value of this spread might not hit its max profit just because Bitcoin hits 125K. Assuming the market is open, if Bitcoin were to hit 125K, you'd likely be able to sell that iBit spread for an amount that would lock in that arbitrage profit. But the other problem is that iBit options don't trade 24 hours a day, which means there's a situation where if Bitcoin did hit 125K during market hours, your spread might have realized close enough to the max profit where you could sell it and lock in that profit. But if that happens outside of regular trading hours, you're leaving room for the Bitcoin price to come back down before you can sell your spread. So what you need to do is have a way to, at any hour of the day, lock in that spread's intrinsic value the second Bitcoin hits 125K. What this means is you need a way to hedge your iBit spread with Bitcoin or Bitcoin futures at any hour of the day. So to do this as an arb, there's a Polymarket leg, an iBit leg, and a potential Bitcoin leg if Bitcoin hits 125K and you end up needing to hedge your iBit spread. To reiterate, the reason we're doing this is because if Bitcoin hits 125K tomorrow, the value of that spread might not hit its max profit because the spread settles to the value at expiration, which may be drastically different than what it is with a few weeks to expiration. The poly market bet, however, pays out if Bitcoin hits 125K before August, not if it's over 125K on August 1st. To account for this discrepancy, we need to lock in the intrinsic value of that spread if Bitcoin hits 125K, and we can do that by hedging our delta. So to go over the entire ARB, I buy some no shares for the will Bitcoin hit 125K on poly market. I then buy a 70-71 IBIT call spread expiring on August 1st. How I pick the ratio between these two legs depends specifically on what I'm trying to do. If I want to make a bullish bet on Bitcoin, I could weight the legs so that the payout of Bitcoin not hitting 125K from the poly market leg covers the cost of the spread. This gives me effectively a risk-free option on the price hitting 125K that pays out a bunch if it hits, but nothing if it doesn't. I could also weight the legs to have an equal payout whether or not Bitcoin hits 125K, so that pure ARB kind of trade. After putting on this spread, this is kind of the tricky part and where you'd have to figure out some solution that works with you to monitor this. As I mentioned before, when Bitcoin hits 125K, meaning IBIT hits 71.40, you want to essentially lock in the intrinsic value of your spread. To do this, you need to hedge the spread's delta. Doing this is simple. You need to short 100 IBIT delta, so the equivalent of 100 IBIT shares of stock. But you want to do this in an asset that trades 24/7, so spot Bitcoin, regular futures. One IBIT share is roughly 1/1750th of a Bitcoin, so 100 shares is 0.057 Bitcoin. So I need to short 0.057 Bitcoin, or about $7,100 of Bitcoin, assuming it's at 125K. Where this gets slightly more tricky is that once IBIT hits $71, which is Bitcoin at like 124.25K, your spread has hit its intrinsic max profit. But in order to realize that max profit instantaneously, you need to have this delta hedge on anytime the price is below $71 and take it off anytime the price is above $71. So the ideal situation is one where IBIT breaks 71 and just rips up and never looks back, or one where it kind of breaks soft and then slowly comes back towards 71 and dies forever. This is where this trade is potentially even better, is there's a small possibility that IBIT hits 71, you hedge your option spread, Bitcoin dies and doesn't break 125K, and you earn on both the poly market leg and the call spread. Or once you've locked in that hedge, if Bitcoin dies, you now have basically a risk-free short on the Bitcoin price. Best case scenario, Bitcoin dies down into the depths of the earth, you earn the full ARB spread and print on your short Bitcoin position. However, you have to be very careful with this hedge, because effectively what you want is anytime IBIT is below 71, you need to be short the equivalent of 100 IBIT shares per spread, but anytime it's above, you need to be out of that position, because now you're short this hedge that your spread has a capped profit, which you've already realized, but that short has unlimited potential downside on the spot price going up. So when IBIT is above 71, you don't want to be short anything. So now you're in this slightly tricky game where you need to be monitoring the price, because if IBIT looks like it's about to break back below 71, you need to short Bitcoin the instant it breaks. And if it comes back above 71, you need to be out of that short the instant it breaks above. What this means in practice is you're probably going to get chopped around trading in and out of this hedge, and likely going to lose money on your hedging trades, but that's just part of doing the ARB. Practical solution here is probably to just not sleep for the next few weeks and set alerts for the price, adjusting it when you need to. Or the simpler solution might just be to trade the poly market leg, because it's almost certainly the mispriced one. That's the trade I'm in. I'm just long the no shares. This is slightly concerning, as going short Bitcoin when it's around all-time highs historically is a terrible trade. However, the size of this mispricing to me is large enough that I feel comfortable just accepting the risk and avoiding all of that complication. So now let's go into the most effective way of maximizing your EV on the poly market leg, because all of that was more just the mechanics of structuring this as a pure ARB, but the actual edge comes from this mispricing on poly market, and you can add a lot of edge to the trade by just executing it more efficiently. My observation on poly market is that intraday, the spot where that edge is going to be biggest, are moments that kind of naively feel risky. So like if you were just somebody looking at the Bitcoin chart with zero other information, though, and you see like you see a candle jumping up and it looks kind of superficially, naively like that might be some kind of momentum signal. It seems like more so than ever in those moments, the market makers in these markets now are really, really aggressively pulling all of their orders. And these are also the exact times when everybody who's kind of naively trading the chart or other things, people on Polymarket, they're all just sending orders market. And so if you can get into those spots and be the best bid in those spots, those are the spots when you can get really, really plus EV filled. So earlier today, Bitcoin was moving towards 120K. We've already broken 120K for the first time. The kind of psychological impact of that level and how that break will move the price doesn't pack the same punch as it did when we broke it for the first time, but market makers on Polymarket treat it as if it does, probably just because they know they can set their prices in ridiculous places and people will buy there. Those are the exact moments where you're going to see the bid for the no shares just drop out, and you want to just put your order right on the top of the book, right above that best no bid, and just wait for those market orders to come in and try to catch them. And ideally, if you were trying to maximize this, putting this trade on in a little bit more of a dirty way and just trying to fill in the 125K and 130K brackets, because that's where the most volume is probably the best idea if you're trying to do some size in this. It really does seem like some of the big market makers got out of the game on Polymarket. The order books are a lot more thin than when Bitcoin was breaking 100K, for example. And so it does take a little bit longer to fill a big order